Welcome back to Asian Century Stocks. This is another quarterly update where I discuss macro issues that I think are interesting, not just for people in the region, but also others who may want to have a perspective of someone who's looking at equities in Asia as intensely as I do. So yeah, as always, remember that none of this discussion should be taken as investment advice. It's purely for informational and educational purposes. Speak to a financial advisor before making any investment decisions. So this is the agenda for today. I'm going to talk about interest rates in Japan. I'm going to talk about my takeaways from my Hong Kong trip, and also the case for gold, and finally Indonesia under new President Prabowo Subianto. So let's dig into it. The Bank of Japan in March, it raised its short-term overnight rate from minus 0.1% to 0 to 1%, 10 basis point range. And this is the first, it's significant because this is the first interest rate increase since I suppose last cycle in 2006, 2007 more. And back then we also had a weakening of the Japanese yen, inflation mostly driven by the weak currency, and that's exactly what we're seeing today. The currency is weakening, and the reason why is because of this interest rate differential between the US and Japan, in my view, and that's probably peaked. That's the key takeaway from these few slides. And the weakening, then of course investors in Japan, they borrow in Japanese yen, and then they put the money overseas, not just in the US dollar, but other currencies where they can get a huge, much higher interest rates. And that's a strategy, that's a carry trade strategy that works well when the yen is weakening, but it can be unwound quite quickly once the interest rate differential starts to narrow, and you do get this unwind, and then you can get quite a forceful appreciation of the yen, I think. It's very weak, the currency is weak, and you can look at it from different ways. This is purchasing power parity deviation, and you can also look at, there are different ways to measure it, but in any case, it's certainly a very, very cheap currency. And you can also see here that wages in Japan are incredibly low, actually lower now than in Korea, which in the past has certainly not been the case, but today it is, and makes you think whether they can actually take market share in manufacturing from Korea. And even compared to Taiwan, the Japanese salaries are actually not that high anymore, which is interesting. So a company like TSMC, if they build a fab in Kyushu, perhaps they're actually making money from that investment. It's not just a case of geographical diversification for national security reasons. But yeah, I mean, you can also see here that the current account hit a new high in March. So certainly it is a currency that does have factors that would seem to imply a strengthening over time because of this positive current account balance. So the core CPI has been over 2% for over a year. So what is the Governor Ueda waiting for? And that's a key question here. All the language that we get from him is very cautious. They're talking about a degree of monetary easing if underlying inflation rises towards 2%. And I guess here he's talking about core inflation or inflation expectations, which are still not perhaps fully anchored. And there's another quote here saying that most policy board members are of the opinion that they need to observe the situation for a little longer, and that we need to confirm whether a positive wage inflation cycle will kick off and strengthen. And now we've certainly seen wage rises in the spring wage negotiations, but so it does seem like we're getting there. So that's on that side. And then I think the US as well, the Fed funds rate is probably likely to drop from mid this year, although we'll see. But this is the Fed dot plot showing that there's a mode of a long-term rate of about 2.5%. If that's the case, if it goes down to 2.5%, we're going to see a strengthening of the yen, although not completely compared to the 80 or so level that we saw at the bottom in 2010. So consumer price inflation in the US is also not really an issue, especially if you adjust for shelter, which is a lagging estimate. So the reason why I care so much about the yen, from an equity investor's point of view, the fact is that earnings growth has been positive in Japan, much stronger than elsewhere in Asia. But that's really because of the weak yen. It's an export nation, and the weakening of the yen has led to earnings growth in yen terms. And also looking at the index, it's hit a new all-time high. The buying has mostly come from foreigners, and then there's this view that locals will somehow step into the market, and that could happen. You never know, right? Now we got this NISA rule change in January, which could entice them to put more money into Japanese equities. But they might as well put the money in overseas equities, when they see the currency weaken. So I'm not sure about that. The TSE reforms are positive, but a wholesale shift in the behavior of Japanese corporates are probably not going to happen. We're seeing changes on the margins here, positive changes. So the question is then, what do you buy? And personally, I'm not finding a lot of value. And if I buy something, I have actually tried to buy companies with imports, have costs in foreign currencies, and I have exposure to Japanese yen revenue, which is quite contrarian. But to me, I'm hoping that for the medium term, that's going to work out better. So I'm personally cautious on buying Japanese equities, and it feels a little bit like we're in 2007 scenario with the coming strengthening of the yen. Takeaways from my Hong Kong trip. So I went to Hong Kong about 2 weeks ago. I was there for 5-6 days or so, and I was invited by this man here called Sven Lawrence from a newsletter called Undervalued Shares, and they have a free tier. They also have a paid newsletter which is really affordable and really thought provoking. I love to read it, and he also organizes trips from time to time, including here Hong Kong trip just a few weeks ago, and he also has a planned trip to Denmark in a few weeks from now, as well as a conference called Weird Shit Investing Conference in New York, London, and soon Hong Kong. While we were in Hong Kong, we saw the index rally, and to me that was unusual to see. I'm not used to that, having been involved in Chinese equities for quite some time. And it felt like we saw a puke in January, and we're now seeing people stepping in slowly. David Tepper, other small investors, small hedge funds in New York and elsewhere are stepping in and seeing the value that I'm also seeing. Low multiples clearly, and global funds. This is an article from Bloomberg saying that the global funds are still not convinced, and that's fair enough. But career risk is an issue until it isn't, and we're getting closer to that point. And the market doesn't seem to be that concerned about the Taiwan risk for now, and neither am I for that matter. And the multiples remain very low, like 10.7 for the Hang Seng index. I think among small caps they're even cheaper. You can get multiples of lower than dividend yield, PE multiples that is. So this is a picture from one of our meetings. You can see me there in the center to the right, clearly very skeptical. I seem to be a bit skeptical, but anyway, good number of meetings. We met 12 companies: Natural Food International, Galaxy, Shineway, Perfect Medical, Anta Sports, Sunderland, Hong Kong Exchange, Plover Bay, Bank of East Asia, Lion Rock, Level Style, and Hypebeast. Some of them were large caps like Galaxy and Anta and Hong Kong Exchange. The others were small cap value investor favorite, let's say, and some of them really quite interesting. Here are some of the key takeaways from the trip. I think the one thing that you notice when you're landing at the Hong Kong International Airport is that they expanded capacity very quickly, about 50% planned capacity increase, and that's a surprise given that the city is supposedly dying, right? So how does that make sense? That said, I felt like Lan Kwai Fong, the bar district close to Central, it felt a little bit quiet, and not as many people around as, let's say, 2019, like pre-protests and pre-national security law. There's been about 4% immigration from Hong Kong, but from Hong Kong Island, that immigration has been higher, and also fewer expats. So if expats hang out in Lang Wai Fong, perhaps that's why I felt like there were fewer of them around. Otherwise, not much has changed since 2020. I think mainland Chinese love Hong Kong. They're attracted by the high wages, which are still, far higher than on the mainland, and also attracted by low taxes. Even though mainland Chinese are still paying they're paying worldwide taxes, or they have to pay higher taxes than locals. But I think the advantage of Hong Kong is still there. The fact that it has the convertible currency freely, there are no capital controls, and it's pegged to the US dollar. So it has, that's a benefit and a disadvantage at the same time. Other things, Café de Coral, Fairwood, Best Mart 360. I think I was quite impressed by these stores and restaurants. If I would say one thing is that I was a bit surprised. There were a lot of people in these restaurants, but except for Fairwood, I didn't see many young people, and that might be a sign that there were fewer young people in Hong Kong after the national security law. But I think there are plenty of upside in retail trading volumes. Only about 10% of volumes come from retail right now. And you can also see that in broker share prices, they're really quite low. And also the stamp duty removal in February has sparked an increase in the transactions, residential property transactions from mainland buyers. And I think the luxury market will benefit in particular because we've had these stamp duties now for almost 15 years or 14 years or so. So that's going to lead to a positive thing, whereas the more high mortgage rates are still weighing on local buying sentiment. So let's talk about gold then. The reason why I wrote about gold is because Stan Druckenmiller, his 13F showed that he's been buying gold miners, small stakes, but still interesting, given how intelligent he is. And I went back and looked at all the times that Stan Druckenmiller has bought gold in the past and found that he's been buying gold during periods of quantitative easing. That's been the case in the 2010s. Also when interest rates fall or when inflation goes up. Or to combine these two, you can look at the real interest rates, which can be seen as the opportunity cost of owning gold. So if the opportunity cost of owning gold is very high, if you get 10% real yield on US Treasuries, why would you own gold? Just take the yield and be done with it. But so if real interest rates drop, you should see gold prices going up. And also, when the US dollar weakens, Druckenmiller has tended to buy gold, and I think that's probably why he's buying it today as well, along with the fact that central banks are buying. This is the Dixie index. If you were to look at the real effective exchange rate for the US dollar, it's even more extreme. I think the dollar is quite expensive at this point. You can also see that on the hotel prices in New York City or menu prices. Prices have really gone up. The US dollar could weaken, at some point. According to Polymarket, Donald Trump is going to be president in 2024, November. And if that's the case, at least Stan Druckenmiller thinks that Trump is a big spender. We're going to have fiscal recklessness without abandon, just like the way he runs his business. And he's talking about potential for 8 to 10% inflation rate takeoff, just like in the 1970s. So makes me feel like we might be in like a 1972 scenario where monetary policy is too tight, close to entering into a recession, and then there's going to be a kind of a response to that recession, which would lead to sustained down cycle for the US dollar and strength in the gold price, which in the 70s lasted from, I don't know, certainly it was a long bull market, but from the recession in 73, it continued going up until 1980. The weird thing, though, about this cycle is that we didn't see a decrease in the gold price after the yields, the real yields went up, and that's very strange. And normally, you would have seen gold price going down to like 1,500 or below that, but this time the gold price held steady and is actually now rising to a new high. And the reason why is because after the war in Ukraine, central banks started buying gold, and that was probably seeing that the Russian treasuries, the holdings were frozen, and I can imagine that Russia, Iran, China bloc countries were getting nervous about it, and instead of seeing gold as an alternative to holding treasuries. And I think that explains this massive buying that we've seen, which to me puts the gold at a permanently higher level, because they're not going to sell this gold anytime soon, I think. So what are the ways to buy gold? One is gold bullion, gold ETFs, gold miners, and futures. Gold bullion, transaction costs are a little bit high. You have to figure out storage. Gold ETFs are much, much cheaper. There are some with high expense ratios but low spreads, bid-ask spreads. Maybe those are better for traders. Low expense ratios are better. Those ETFs are better for long-term investors. Then you get futures and then gold miners as well. People always talk about how gold miners are lagging the gold price. It's going to be catch-up growth and such. I'm not so sure about that. I think most of the underperformance is due to poor capital allocation. And adjusted for share dilution, actually, the operating cash flow per share is exactly equivalent to the share prices. So they don't look particularly cheap, at least not North American miners. So to summarize, I think we will continue to see this correlation between real interest rates and gold. And the reason why we didn't see it this time around the last 2 years is because of this war in Ukraine and this buying from central banks. But if we do see a sustained interest rate decrease, into a recession, let's say, I think gold prices will continue going up, especially if there is some kind of a forceful response that leads to a weakening US dollar. It's an interesting trade, interesting bet on Trump, if nothing else. And I wouldn't say necessarily buy gold miners, since they tend to be quite poorly run. But yeah, that's it. Lastly, I want to talk about Indonesia under Prabowo Subianto. So it has a new president now. It's going to have a new president from October 2024. And this comes after 10 years of this man, Joko Widodo, or Jokowi, who used to be a businessman, a furniture exporter turned politician, and is widely seen as being positive for Indonesia's development. We saw construction of new infrastructure, like the road system has really improved under Jokowi. And there's also been railway lines and new subway in Jakarta, as well as they're now going to build a new airport in East Jakarta, as well as a new capital city in Nusantara in East Kalimantan. So that's to me fascinating. It just shows that he's willing to deal with the problems that Jakarta has faced in terms of traffic jams and such. He also helped industrialize the commodity base by, for example, forcing nickel refiners to be placed within the country, and that's led to a new industry for Indonesia, and also introduced this omnibus law on job creation, which has made it easier to hire and fire people, and also reduced the barriers for foreign direct investment, as well as barriers for purchasing land. And that hopefully will lead to FDI flows, manufacturing, a growing manufacturing sector, as well as spin-off effects that we always get from manufacturing in a particular country. But he's also tried to remove term limits, which led to a huge backlash, and he had to step away from that ambition. And he's also been, charging critics of him with defamation, and that's obviously concerning. His second son is now the vice president, although without much power. And the new person in town, the new president here, is Prabowo Subianto, who won with a huge margin. He was portrayed in the social media campaign as super cute and cuddly, and I don't know how he pulled that off, but he is a military commander. He was a military commander under Suharto before he became a politician. He was married to one of Suharto's daughters. He later divorced her, but still a very close relationship to him. And he was involved in a number of human rights violations, including suppressing dissent during the 1998 riots, when 30 or so students were just disappeared. and also in East Timor and Papua. He's vowed to continue Yukovic's policies, but he holds all the cards now, and who knows what happens after October. My guess is that this Raka, Yukovic's son, is going to be sidelined very quickly. Now, Prabovo's 2015 book, which would probably ghostwritten by somebody else, but anyway, he does lament that Indonesia lost its way after the fall of dictator Suharto, and that to me is highly concerning because it was a period of it was dictatorship and a period of crony capitalism and state control, or rather controlling the large part of the economy together with his cronies. So that's likely possible. That's one possible scenario that we're going to see more state control investments. The big question is whether we're going to see a return to a 1945 constitution, and if that's the case, like martial law being reintroduced again, all bets are really off. And this is interesting because we're seeing something similar now with Bongbong Marcos in the Philippines. He's been pro-business so far, but of course anything could happen. And the fact that Finance Minister Sri Mulyani Indravati is going to resign, it probably means less fiscal discipline. And also the fact that Prabowo, he's been talking about taking raising taxes into an entity that's outside the finance ministry, also opens the scope for corruption. And that's a little bit concerning to me. So negative for the rupiah for sure, and potentially also for the Indonesian equities. And it is something that I'm very concerned about when it comes to Indonesian equities. Now, usually in Southeast Asia, you don't have to think too much about who's the president, but perhaps in certain situations when you do get a move away from democracy into, if martial law is introduced, let's say, in any country, that could be problematic. And let's just hope it doesn't happen. But certainly I'll become more cautious on the rupiah, and perhaps a bit less so as well, bit less bullish on Indonesian equities as well. So to conclude, I think there's a good chance that the US-Japan interest rate differential has peaked already, and that therefore the Japanese yen, the path of least resistance is for the yen to strengthen over time because of this current account surplus and the competitiveness of the Japanese export economy. Then that has a negative impact. If we do get an appreciation, it will have a negative impact on earnings growth for the Japanese market as a whole. Although some companies, like service companies and also the companies that are importing, or companies that have costs in overseas currencies, will probably benefit. Now, small caps are cheap and have suddenly become investable again. That's what a lot of people are thinking. A lot of investors feel like buying Chinese equities again. And they remain really cheap, especially small caps in Hong Kong. You can get P ratios that are below their dividend yields, and that's typically a good sign. So yeah, I mean, there are challenges. I don't want to talk too much about those, but it does feel like we've gone from extreme nervousness to investors actually wanting to invest in Chinese equities again. And I haven't seen that for quite some time, except for a short period in November 2022. Now, gold protects against inflation, but only over the long run. So I do think they will benefit from a Trump presidency, but so will US dollar assets, I think, if we do get this new response to economic weakness that I personally predict. Then new Indonesian President Prabowo Subianto, I think he has dictatorial tendencies, and that his election is going to be negative for the rupiah. We're going to see less fiscal discipline, and these twin deficits have historically been very negative for the rupiah, and that's concerning to me. That's it. Thank you so much for listening. And if you're interested in learning more about what I do, I have a Substack newsletter called AsianCenturyStocks.com. It's my full-time job, and I talk about value stocks in the Asia Pacific, typically over 20 per year. And they tend to be quite undiscovered companies that people don't really talk about otherwise. For example, this year only I've talked about Bestmart 360, Lao Fengxiang, Pentamaster International, Prosus, Property Guru, Ginebra San Miguel, Straco, Amex China, Taichung. and much more. So if you're interested, do check out the Substack, and I look forward to hearing from you there. And thank you so much, and I'll see you next quarter.